So when you put the game on your side, the market charges you more. When you put the game on the market side, the market charges you less. Are we trapping right now? Right, so last week the queen asked me about rolling a play down. So it kind of goes like this. Let's say I got my dog in here, Alex. So let's say we'll call his stock Good Energy Trucking, GET. Right, so let's say GET, come on, dog. You heard me? Good Energy Trucking. So GET is trading, so let's say we got a call on GET for 150. Stock is currently trading at 125. We got an expiration date on GET for, let's say, June. So 3 things that this tells us. 1, we got GET stock, Good Energy Trucking. We got a call option on it, means we think the stock gonna go up. We put a price tag on it, which is a strike price, saying we think that this stock gonna go from 125 to 150 by this expiration date, June, we'll just say 10th, 2025. So let's understand what this is. This is gonna be what's called on an options chain, right? So on the chain, they're gonna have different prices, and they're gonna have different volumes, they're gonna have different open interest, it's gonna have different deltas, a whole bunch of things. But these are the most important things that you need to understand about this. Now, watch this. Once you get 30 days close to this, so once you get to May, the time gonna speed up on this, because now you're getting 30 days closer to the expiration date. Now what that means is that's gonna be called theta. So that's your time and how this thing moves. That's gonna start speeding up on you. So like around April, so let's say we're in February. So March and April, it ain't gonna move as fast unless the stock do something drastic. But once you get into May, now you done got 30 days close to that expiration, everything speeds up on you. Everything gonna speed up on you. Meaning if it go down $1, that dollar gonna be real harder to bounce back from. If it go up $1, that dollar now has a little more value and it's hard to take away from you. But once you get inside 30 days, it's harder for you to recover from an L. So that's why I always say in our plays, once we get to 30 days, I'm making the distinction, do I exit or do I chill? The reason why I exit, if I'm up a little bit, like we up 10, 15, 20, 30% on a play, 40%, and I'm inside that 30-day range, I'm willing to take that profit and go about my business. So the goal is to lock in profit before you get to that 30 days. So I look at it as like a red light. Once I get to 45 days, closer to the expiration date, I'm in yellow light mode, which means I gotta slow down and start really paying attention to what's going on. At the 45-day range, you now making that decision pre-30 day. So you saying to yourself, I'm in 45 days. If I'm up or I'm down, I need to be ready to make a decision whether I'm going to exit this play or whether I'm going to take my profit and go about my business. Once you get into that 30-day range, now you're in that danger zone. You got to make a decision here. Either decision, you're saying, okay, 30 days, I'm up 50%, trap. I'm willing to take half of this out this play and see what the other half do within those 30 days. Either way, you good. But if the stocks swing on you against you in them 30 days, it's really hard for you to recover. Does that make sense? So you want to always give yourself recovery time. That's why I say day trading is for heroin, because you don't have no recovery time. You got to be on your P's and Q's. Niggas are strapped every day, all day. They strapped, they ready, they're ready. All right, so here's what you're gonna do here. The 125 doesn't have to hit 150 for your play to start turning profit. Okay, that's important. The 125 doesn't have to hit 150 to turn profit. But I'm about to tell you something that's gonna be crazy right here. Let's say you in May and your 125 is at 130 because of the time and the expiration date, your play can actually be negative. So what happens is, now that you inside this 30-day range, the theta is now against you, and you need the stock to perform better than normal. So you can be making ground, but because you inside of this range, you can actually not be profitable. We're going to use the same situation, and what we're going to do is we're going to roll it. Hear me out here. So let's say you got the 125 strike price. We are now in May. It expires in June, and you like, bruh, I like this play, but I'm down $100. We're going to just use that. We ain't going to go crazy. So here's what you do here. You say, Trap, I'm going to take the GED stock, the good energy trucking stock. Trap, I'm going to keep the 150 call. Watch this. But I'm going to roll it out from June to September. You just rolled it out. All right? Watch this. What the market gonna do is say, you took the same strike price at 150, you rolled it out to September, you was minus, I'll just put a number out there, $25. Just gonna put a number out there. What the market gonna say is, you gonna then receive whatever the remaining you got left in there. Let's say, I'm just using a number here, let's say you got, I don't know, $900 in it, right? Because it costs you $100. Let's say you bought however many contracts. What the market gonna say is, whatever this contract costs to get it to extend this out, they're gonna say whatever you got left in that, we gonna add it to this, and you gonna just pay me the remainder. Does that make sense? You use the same strike, the same play, good energy trucking. Because it wasn't performing here for you like you wanted, but you like the 150 call, you rolled the play down. You say, I'm going to take the 150 call and keep it. I'm going to stretch it to September. You was down $25. The market, you still took, watch this. This is the part that people forget. You still got to take that $25 loss. You do not avoid the loss. Most people think when you roll a play down that you avoid the loss. You do not avoid the loss. What you're only doing is offsetting the loss. So they're saying you down $25 bet. Whatever much you got left in there, we're going to take that and then add that to what this thing costs, and all you got to do is pay the rest. Does that make sense? Instead of you saying, go and get the whole thing from my account, you just transferring the balance. Come on, y'all. Let's go. Let's go. All right. Now, watch this. You can also do it like this, Jose. You can call this like a roll and extend. So watch this. You can say, Trap, here's what I want to do, Trap. I want to take the GET, the good energy stock. Watch this. I don't like the 150 call. So now you can say, I'm going to take the same thing. Watch this. I'm going to roll it down. Now you rolling it down and you extending it out. You doing this. Now you saying, Trap, I want to take the 150 call. I'm going to go with the 140 call because the stock is at 125, and I'm going to bring that thing out to September. This play probably gonna cost you a little more because you went closer to the strike. So the market gonna tell you the same thing. If you was down $25, whatever this play cost you, they're gonna offset that. You're gonna take that loss. They're gonna take the remainder of it from your account, and now you just in the GET 140 September call. Does that make sense? So people think that because you roll a play down, you don't take the loss. No, you offset the loss and you just get it a new play. Now, let me give you another scenario because the queen asked me, and it's important that I give it to you every way that I can think about all the time in my head. I can take the same GET call. Watch this. I'm 30 days in, and I'm like, trap. They got earnings coming up. They got some stuff coming up. So here's what I want to do. I'm going to take trap. This is rolling the play up. Watch this. Trap, I'm going to take the same. I'm going to take the 150 call. I'm going to go with 140. Watch this. Let's say this play was a June. Watch this. Let's say this play was a June 25. In some cases, you can take that same play, switch that price and say, trap, I'm going to go from a June 25 to a June 10. Because you'll find some plays that have multiple dates inside of a play. And so now what you just did was you rolled the play closer because you said, trap, I want to play earnings. And watch this. That play is probably way cheaper. Because you just risked, you took a bigger risk. So when you put the game on your side, the market charges you more. When you put the game on the market side, the market charges you less. Those are three scenarios that we can do. We can take the same strike price, we can stretch it out, expiration date. We can take the same strike, roll that down, stretch it out, come in, or we can take the same, or we can change the price and the date. That is essentially you rolling. That's a roll. You rolling up, you rolling down, you rolling out, or you rolling in. And so adding a leg is just going to be simple as I'm trapped, the stock is 125, strike price 150. How do I add a leg? It's simple, bro. You just take the same price. You say, hey, the price is this is a June call. You in May. Hey, well, you in June, let's say you got a June call right here. We in February. The stock goes from 125 currently to 100. You say, I want to keep that call, adding another leg and just saying, yo, I'm going to get good energy trucking again. I'm going to bring it in. Instead of having a 150 call, I'm going to go with a 110 call and I can keep it at a June play and it's still in February. You just added another leg to a play. That's all adding a leg is. Adding a leg is saying, I'm taking the same thing. It ain't no different. We'll use it again. All you did was add a leg. What is that? You already in the 120. The stock is already 125 when you bought it. You're going for a 150 call in June. Well, it's February. Let's say we had a day like today, this week. Now the stock ain't 125 no more. Now it's $95. Well, you like, trap, I still like this 150 play, but it's at $95 now. Well, what do? Well, you get GET, and you said, bruh, instead of having a 150 call, trap, now I like the 115 call, and I like it for June. Or you may say, I'm going to go out a little further. I like it for July. It's simple. You got the 115 call in GET trucking. You got it at June or July. You just added a leg to it. So now you got two calls. And if you go back to my recession portfolio, you see I got 3 legs in one thing. You added a leg and you roll down.